Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money moves of big business. And let me tell you, Progress Software Corporation's latest report is a real page turner, full of surprises and some interesting financial gymnastics. We're diving deep into their quarterly results, looking at how they are performing, what is driving their business, and what it all means for their future. If you like to get the real story behind the numbers, make sure you are subscribed and hit that notification bell. And hey, if you want to chat about these reports or get more in-depth analysis with other finance fans, come join our Discord community. The link is in the description below. So, Progress Software Corporation, they in the business of making software that helps other companies build and manage AI, powered applications and digital experiences. Think of them as the enablers of the digital world. They sell software licenses, but also have a growing part of their business in subscriptions and cloud services, known as software as a service or SaaS. They also picked up a company called ShareFile in October of 2024, which adds a nice chunk to their subscription business. Let us jump right into the numbers for the quarter ending the 31st of August 2025. Looking at their assets, they have a hefty sum of $2.4 billion. A big chunk of that is goodwill, which is basically the value of the company over and above its identifiable assets, often from past acquisitions. They also have a significant amount in intangible assets, totaling over $619 million, which are things like patents, software, and customer lists that can be touched, but have value. On the liability side, their total current liabilities are just under $770 million. That is a pretty big jump from November of 2024, largely driven by a significant increase in their short-term convertible senior notes. This means they owe a lot of money that is due within the next year. Now, for the stockholders' equity, which is what is left for the owners after all debts are paid, it stands at $477 million. This has grown from $438 million at the end of November 2024, which is a positive sign. Moving on to how they made money and what it cost them. Let's look at the income statement. Total revenue for the 3 months ending the 31st of August 2025 was almost $250 million. That is a big jump of 40% compared to the same period last year. And for the 9 months ending the 31st of August 2025, revenue hit over $725 million. An increase of 35%. A big driver of this growth is that ShareFile acquisition we mentioned earlier. It contributed about $194 million to revenue in the first 9 months this year. Software license revenue saw a modest increase of 10% in the third quarter, bringing in over $63 million. But as a percentage of total revenue, it's actually down, making up only 25% of the pie. This shows the shift towards subscription-based revenue. For the first 9 months, license revenue was actually slightly down by 2%. This is where the real action is. Maintenance, SaaS, and professional services revenue surged by 54% to over $186 million in the third quarter. For the 9 months, it jumped a massive 52% to over $552 million. This segment now makes up 76% of their total revenue, highlighting their successful transition to a more recurring revenue model. The SaaS revenue alone jumped a staggering 1,076%, mainly thanks to ShareFile. The cost to deliver those software licenses stayed pretty stable, around 4% of the license revenue. This is pretty typical. However, the cost to provide maintenance, SaaS, and professional services went up quite a bit, by 69% in the third quarter and 56% for the 9-month period. This increase is largely driven by higher hosting costs and more staff needed for these growing services. Especially after acquiring ShareFile, as a percentage of their revenue in this area, it's about 18%, which is a healthy number. This all led to a solid increase in gross profit for the third quarter. It was over $202 million, up 35%. For the 9 months, it was nearly $585 million, up 31%. However, the gross profit margin did dip slightly from 84% to 81%. This is mainly because those costs for maintenance and SaaS are rising faster than the revenue from those services, which is a common challenge as companies scale these offerings. Now let's look at their operating expenses. Sales and marketing costs jumped 40% in the third quarter and 34% for the 9 months. This also ties back to the ShareFile acquisition, with more staff and marketing efforts needed to support the expanded business. Importantly, sales and marketing expenses as a percentage of total revenue remain stable at 21% for both periods. This means they are growing their sales and marketing spend, but at a pace that aligns with their revenue growth, which is usually a good sign that they are investing efficiently. Product development expenses also saw a significant increase, up 42% in the quarter and 35% for the 9 months. Again, this is largely due to the integration of ShareFile and the need to invest in new and existing products. As a percentage of revenue, it stayed pretty consistent around 19 to 20%. This shows they are continuing to prioritize innovation, which is crucial in the software industry. General and administrative costs, which cover things like finance, HR, and legal, also rose by 38% in the quarter and 25% for the 9 months. This is also linked to the larger organization post-ShareFile acquisition. Interestingly, as a percentage of revenue, these costs stayed relatively consistent or even slightly improved for the 9-month period. Putting it all together, their operating income, which is profit before interest and taxes, increased to over $43 million in the third quarter. Up 9% for the 9-month period, it grew 12% to over $114 million. While revenue growth is strong, the increases in costs mean operating income isn't growing as fast as revenue. The operating margin has decreased from 23% to 18% in the quarter and from 19% to 16% for the 9 months. This indicates that while they are growing, their profitability per dollar of revenue has decreased. The biggest change in their other expense section is a massive jump in interest expense. It more than doubled, up 162% in the quarter and 157% for the 9 months. This is directly related to the debt they took on to acquire ShareFile. This higher interest cost is a significant drag on their bottom line. Their provision for income taxes increased by 17% in the quarter, but decreased by 19% for the 9 months. The tax rate itself has fluctuated. For the quarter, it went up to 26% from 17%, mainly due to some one-time tax expenses. This means a larger portion of their pre-tax income is going towards taxes. And finally, net income. This is the bottom line for the third quarter. Net income fell by 32% to just under $19.5 million. For the first 9 months, it dropped 30% to about $47.4 million. The big increase in interest expense, combined with slightly lower operating margins and those tax items, has hit their net profit quite hard, even with the substantial revenue growth. They also have convertible senior notes. The carrying value of their 2026 notes is about $358 million, and their 2030 notes are at about $440 million. The fair value of these notes is higher than their carrying value, suggesting that the company S debt is trading at a premium, which can be a good sign depending on market conditions. Now, something else that is important to note is the ongoing impact of the MOVEit vulnerability that happened back in 2023. They are facing class action lawsuits and investigations from government authorities. While they are incurring costs related to this, they are also getting some insurance reimbursements. They are actively managing this situation, but it is a significant ongoing risk and expense. They believe their cybersecurity insurance, with about $5 million remaining, will help mitigate some of the exposure. Moving on to some performance metrics not directly from GAAP, I want to talk about AR, or annualized recurring revenue. Progress Software defines this as the annualized revenue from all active binding contracts. It is a great way to see the predictable revenue stream of the business, and it is looking strong. Their AAR was $849 million as of the 31st of August 2025, a 47% increase from the previous year. This is a fantastic growth number and clearly shows the success of their subscription strategy and the impact of ShareFile. Their net retention rate has been consistently around 100 to 102%. This means that for every dollar of revenue they had from existing customers a year ago, they are now getting that dollar back plus a little more from those same customers, even after accounting for any customers who left or reduced their spending. This indicates strong customer loyalty and the ability to upsell or cross-sell, which is a very healthy sign for a subscription business. Let S touch on liquidity. They had about $99 million in cash and cash equivalents at the end of August 2025. This is down from about $118 million at the end of November 2024. The decrease is mainly due to paying down their revolving credit facility, repurchasing stock, acquisitions, and paying down debt. Their cash flow from operations was pretty good for the first 9 months, generating over $172 million. This is good, but it is lower than the nearly $192 million generated in the same period last year. The higher interest expenses are a key reason for this drop. Investing activities used about $23.5 million, mainly for an acquisition. Financing activities used a significant amount of cash, over $175 million during the first 9 months of 2025. This includes paying down their credit line, stock repurchases, and some debt-related costs. Importantly, they also received proceeds from issuing senior convertible notes in the prior year, which helped fund things. So, what does this all mean? Progress Software is clearly in a period of significant transformation and growth. The acquisition of ShareFile has dramatically boosted their revenue, especially in the crucial SaaS segment. Their recurring revenue, measured by AR, is growing at an impressive rate, and their customers are sticking around, as shown by the solid net retention rate. This shows they are executing well on their strategy of shifting towards more predictable subscription-based income. However, this growth isn't without its costs. The increase in debt used for acquisitions means higher interest expenses, which is directly impacting their net income. While their operating income is up due to revenue growth, the profit margins are squeezing a bit because costs are rising faster than revenue in some areas like SaaS and services. They are also navigating the ongoing fallout from the MOVEit vulnerability, which is a reminder of the inherent risks in the software business. The company is definitely moving forward with bold moves, but it will be important to watch how they manage the increased debt load and whether they can improve their operating and net profit margins as they continue to integrate their acquisitions and scale their SaaS business. The future looks promising in terms of revenue growth, but profitability and managing those interest expenses will be key to sustained success. Alright, that is our breakdown of Progress Software's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their aggressive acquisition strategy will pay off in the long run? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. And for more discussions and to connect with us and other finance enthusiasts, check out the Discord community link in the description below. Thanks for watching. See you next time.